The global economy and the stock markets are completely separate, and right now the economic indicators are showing things are really looking grim. Stock markets have risen, but the economy continues to weaken. Globally, we have seen stocks rise everywhere in a straight line upwards since the end of 2018. Throughout 2018, however, we had witnessed protracted weakness among several economic indicators. But of course, the media refuses to cover that. They won't touch it. But for those who want the truth, it's out there for us to see. And that's why you came here for the truth, so let me unveil that for you. Today, we are going to look at the global economic deflation. I'm going to cover specifically Canada and the US, beginning with the United States. Let's take a look. The GDP numbers are a farce, they're a fake, and you tend to see the revisions that come out. So initially they say the economy is going to grow at 3%, or the economy grew at 3%. And then later, after that news is already published and after the stocks have already risen and everything looks great, then they post something later on that says, oh, by the way, we're revising that downward. This is something that everybody should be paying attention to. On the New York Fed website, they have this, as you can see right here, the nowcast, which is 0.88 as of the first quarter 2019. The data comes as of March 1st specifically. We are looking at extreme weakness this quarter so far. We'll see what happens as time goes on, but I need to make sure that I mention exactly how it's broken down. On the right hand side, you can see all of that data if you're interested. But all I want to note is that whenever they initially put out a number, it seems to get revised down afterward, and the media never seems to cover that. Then we have the Atlanta Fed that puts out the GDP Now forecast, and it shows us as of March 1st, 2019, 0.3%. It looks terrible on every level, always worse than what we are being told. They're going to suggest that this has something to do with the government shutdown. This is the reason, not that we had any weakness before that. This is the only reason, and we'll see how they try and spin it. We keep hearing about how manufacturing is coming back to the United States and manufacturing jobs are becoming abundant these days. Well, let's take a look at the PMI indicators here, and you can see how they have been falling off a cliff. You want to look at the blue and the green lines, just showing you the PMI weakening, not just over the last month, not just over the last couple months. We have seen it peaking out in 2018 and falling ever since. This is not a good sign coming at a time when we have record stimulus in the economy, the interest rates near record lows. The market can go up, but the economy will continue to suffer because quantitative easing doesn't make its way into the actual economy. It doesn't work like that, and it never was intended to work like that. Of course, they acknowledge that. However, the media is not willing to tell people how it is. They have to be spoon-fed. That's the way people are today. They need to be spoon-fed on a daily basis. Here's your information that's important to you. You'll only get to learn this amount of info, and the rest of it, just stay out of it. Let us take care of that. The IHS Markit US manufacturing PMI dips to an 18-month low in February. I'm sure that's going to continue throughout March unless we have a big change with the US and China's trade agreement. Once again, they project to the media that they're going to sign a deal. There's been nothing actually out there, nothing other than the intention of China to buy more agriculture products from the United States. They've put that message out, but nothing has been set in stone at all since the beginning of these negotiations. Not even one piece of paper where they can simply say, okay, we agree on these parts, but we're working on other parts. Nothing of that sort has happened at all. Absolutely none. They have just been rumors from inside saying, well, a source familiar with the matter says that they're going to sign an agreement in the coming weeks. A source familiar with this says that they're going to do that. It's all garbage. I don't know why people believe it. Technical recession possible in Canada after disappointing economic data. That's according to TD Bank. With Canada's economy in a lengthy hibernation, we can at least rule out more interest rate hikes for now. That's what they say. Well, of course, you need to keep the interest rates at record lows. Right now in Canada, you can get a mortgage for about 3.5%. It's ridiculous the way that they're handing out money to people, and of course, they are taking advantage. If the money comes easy, people will take it. They will go into the maximum amount of debt. I just covered a video about how individuals are taking home equity line of credit at the absolute maximum they ever have. Right now, the average is $70,000 worth. And why? Because the money is cheap. Why not? I'll just buy that Maserati. I can finance it for an extremely low price. That's what they're doing today. And you go around these major cities and you see the exact same thing. It doesn't matter if it's New York City, Toronto, Vancouver, San Francisco, all of the same patterns are occurring in places all around the world. Canada's economy practically came to a halt in the final 3 months of 2018 in a much deeper than expected, well, depends on who you're watching, slowdown that brings the underlying strength of the expansion into doubt. I don't know what expansion they're talking about. I don't know what strength that they are discussing here, but I'll tell you right now, the problem within Canada is that you have individuals that rely solely on the value of their home to keep the economy going. As far as I'm concerned, that is a disaster waiting to happen. There are always going to be times in which they stall, and then you're going to have a serious issue because people's wages are definitely not keeping up. So that home equity line of credit is going to become a burden on individuals, their mortgages, where in Canada, the amount of time that you get a mortgage for, the actual negotiation of the terms only lasts approximately 5 years. It depends, you can get longer or shorter, but that's kind of the sweet spot for rates. So every so many years, people are then refinancing, and of course, interest rates cannot remain low forever. Why? Because in order to do so, the government has to print money in what in the US they call open market operations. Open market operations are basically printing money. So you cannot do this forever without destroying the currency. I have a video about that. If you're interested in open market operations and how they work, go to the end of this video and I will link to that one. If you haven't seen it already, it's part of my free e-course. Click on it and I will give it a download. But let's look further into this. Essentially what we're looking at is that the stock market in Canada has performed extremely well over the last couple months, and that has been in connection with what we have seen with other markets around the world. China's markets, the US markets, it doesn't really matter. We are seeing all of them rising together. The markets are very confident, but the economic indicators do not correspond to that. Well, we've got some disconnect. Here you can see the month-to-month GDP going into the negative. That's looking terrible for Canada at a time when they cannot afford this because the global economy is suffering and Canada needs to do well. They need to see the US do well as well, simply because they are their #1 partner. 87% of the exports of Ontario, just as an example, go to the United States. If the United States doesn't want to import those, then we have a problem. Canada All Industries monthly GDP year over year. You could see what has happened from 2017 up until present. Of course, it's a year over year statistic. You're looking at these numbers, which fluctuate wildly all the time, but I just wanted to give you an idea of how this has been over the last several months. I want to flip back to the United States for a minute now that we're done with all the GDP stats. This is the real personal spending month over month, and it declined to a level that we haven't seen since the financial crisis. Of course, how many different indicators can I show you that have gone back at least to the financial crisis? Many have surpassed it in so many ways. This right here gives us the impression that people are worried right now. They're a little bit concerned. They're waiting and seeing what's going to happen. They don't know. Is it the government shutdown that's the problem? They don't know what's going to happen with interest rates. They're kind of just sitting on it, waiting, and they're going to acknowledge this at a future time. At the top, you can see US personal income month over month that has moved into the red, and you don't often see this at all, but it looks like this has happened right now. We'll see what happens. It could definitely turn around in a month. It's not really such a big deal, but I just wanted to show you that in connection with all this other data. I've talked about the problems with the auto loans in the United States today. Many are becoming delinquent. In fact, if I remember correctly, we have about 7 million of them that are 90 days plus in their delinquency. That's not a good sign, but don't worry, it's only 7 million. That's what I saw the comments there. Out of the total of them, oh, it's only 7 million. Well, whatever you want to believe, that's fine. New monthly payments hit $525. That's an all-time high. People are stretching this as far as they can, and there's always people who will say that's totally fine because interest rates are low. Why wouldn't you want to stretch that out over time? But they're not understanding the fact that the longer you stretch it out for, the more you eventually have to pay. And that's not good. It's as if you're getting an interest rate on your home. You're saying, okay, it's 5% interest on this $500,000 home, and that's it. Low interest, $500,000 home, but they're not calculating the fact that the longer I take to pay this off, the more interest is going to compound as time goes on. You want to pay that thing off as soon as possible. Don't think of it on your own personal residence as if you should stretch it out for 30 years. You want to get rid of it. Now, if it's a rental property, then we can have an argument. Then you could say what's better or not. But on your own personal residence, why would you ever want to carry debt? It's ridiculous. And just to finish the video off, you're seeing Heineken USA announcing that it would slash 15% of its overall workforce. Just another company in the United States that's laying off a massive amount of people. We're not talking about a couple hundred jobs or even a couple thousand jobs. There have been so many jobs, and I've been showing you time and time again. We've seen thousands and thousands of different stores that have closed all around the United States, and these are big stores, ones that really employ a lot of people, but nobody seems to be freaking out as long as the stock market is going up. In December, they started to freak out because the stock market was going down, and suddenly people started pointing fingers left and right. But then the stock market went up and the complacency went back to where it was. Well, congratulations if you made it this far into the video. You really do know what's going on. If you found this video informative, please give me a thumbs up. When you give me a thumbs up, you are supporting this channel, so I do appreciate that very much. And last but not least, if you want the financial education you weren't taught in school, that was kept from you from the school system, well then these two books have what you need. Check them out at the link in the description if you want the audiobook that's available at themoneygps.com. If you want to find out about open market operations, check out this video. It explains it very simply. Click on it and I'll see you there.